All right, it is 11, so we are going to get started. My name is Trent Zimmermann, and I'm the Annuities Director here at BGA Insurance. BGA Insurance is an independent wholesaler working with independently licensed insurance agents uh, to wholesale life insurance, annuities, long-term care, and disability. Myself, I have a bachelor's in economics, master's in finance. I'm a chartered financial consultant and a chartered life underwriter. And this is your 20 minutes. Some housekeeping before we get in, and a quick apology as well. I was sick from Thursday evening until really yesterday. Still getting over it a little bit, so I might have some pauses to keep my throat clear. And if I do any throat clearing, forgive me. But we are going to be switching over to a webinar setup instead of this meeting setup. Help us on our side being able to put these up as recordings for all of you to watch later. But that does mean that there's going to be a new link. So you're going to all get a new invite to sign up for this next week, and it will be the same ongoing invite moving forward, just like this one was, but it will be a new link. So make sure you sign up for that. It's going to be moving over to a webinar instead of this meeting. Now, we're talking about rolling over annuities. Why? If you've been on any of these before, you've heard me say there are $60 billion in MYGAs that are up for renewal this year, and 400 billion in annuities sitting outside of surrender or will be coming out of surrender this year, in including RILAs and FIAs and variable annuities as well. We're also living through right now peak 65, a record-breaking 4.1 million Americans turning the traditional retirement age of 65. That's going to go through 2027. And the Great Wealth Transfer, where it's the largest shift in wealth in the history of the United States from baby boomers and the silent generation to Gen X, mostly, then millennials and a little bit charities as well. Now, if you aren't having these conversations of what they're going to do with these existing annuities that they have that are out of surrender, someone else is. And I want to note something in here that annuities are not designed to hold up after surrender. Unless you're doing an income annuity where you're pulling guaranteed roll up from it, the cap and the pars are designed to fall apart outside of surrender because they're buying a fixed bucket that is going to last the length of the surrender period, so 5, 7, 10 years, and they're using that to buy the options. And now once you go to outside surrender and you can leave within a year, they're not going to be investing in the same long-term yield fixed income investments. So they're going to be buying short-term debt that's going to have much lower yield and buying shorter term options that are going to have a smaller yield as well. So your participation rates and cap rates are going to collapse no matter who the carrier is. They are designed to. So it's in the best interest of your clients to roll over their annuities. And if you're in a MYGA, if multi-year guaranteed annuity, they could be automatically moved into a renewal product, which could be their market product. It could be a off-the-shelf product, or it could be a year-to-year rate. These are not beneficial for your client unless they're being rolled over into the current market product, and that market product is the most competitive out there, which it rarely is. These companies are competing in the MYGA space, change from month to month. It is in your client's best interest to sell them on a new annuity when the surrender period has arrived, or else they will not be getting the best caps, pars, or guaranteed rates available to them in the market. So, what do clients want though when we're looking at rolling these over? You could be rolling them over into the next MYGA, you could be rolling them into the next fixed index annuity, but 82% of clients rate long-term care as their number one financial concern. 42% believe the long-term care event would deplete their savings. 78% of clients expect to discuss philanthropy with their financial advisors. 64% of people fear running out of money more than death itself. And 42 people report being underinsured for life insurance. These are the big things your clients want to be talking about. But I think we get in our own way a little bit and not have these conversations, have the easy ones of what do you want to roll over into next? Here's the best rate. Which, great. At least you're having those follow-ups. Most advisors aren't. Most of the business we saw sold 3 years ago on short-term MYGAs that's being rolled over now are being sold by different advisors than the initial MYGA was sold from. In other words, advisor A sold me a 3-year MYGA when rates went up in 2023. Now 2026, advisor B is selling me on a 1035 exchange out. Now that's a surrender. Don't let that happen to you. Get in front of this, talk to your clients when it's time for a renewal. So now we're going to go through these different buckets and some strategies. I'm not going to go deep. I'm not going to go into the details of each. I'm not going to go into complex explanations of tax implications and so on because we got to cover a lot of material here. But we're going to cover these four buckets: long-term care, philanthropy, income protection, and life insurance. We're going to go from easiest though. We're not going to go from that order that I gave you there because funding the basic needs is the easiest. We've talked about this before. There is a number for almost every individual that annuitizing some part of their retirement portfolio will increase their terminal portfolio at death. It reduces their risk of running out of money. When we talked about it, cut that by 50%, whatever their risk number was, it cut by 50%. And there's a Morgan Stanley and BlackRock study that showed that at a minimum, there was a 10% increase in terminal portfolio. The size of your portfolio when you died was at least 10% higher. So if you could say to your clients, I can protect your income so you'll never run out of money, and when you die, you'll have at least 10% more to pass on to your heirs. Would you say yes to that? Absolutely. So the number one thing is 1035 into an income annuity to fund their lifestyle. Whatever their baseline number is, roll their annuity over into an income annuity to pay for that. Second one is AUM protection or RMD offset plans. So Secure 2.0 increased the RMD offsets, the required minimum distribution from annuity payments. So single premium annuities get more because they have less, they have no cash value. They might have a death benefit as opposed to a fixed index annuity that will have a cash value. So because of this, the single premium annuities will count more towards your required minimum distribution offset. And so you can remove that money from your portfolio from counting and count the income as part of those withdrawals. So it's a great way to protect your assets in your assets under management, to offset your RMDs, and be able to fund your retirement as well. And so you can 1035 into a single SPIA to deploy at 73 to offset those RMDs, or you can create a SPIA and DIA ladder. So DIA is a deferred income annuity, SPIA is a single premium immediate annuity. And so you can ladder those out to deploy at different parts of your retirement, starting at 73, so that you're periodically pulling money out of your retirement portfolio so it doesn't count towards the RMD calculation, and creating income streams that counts towards offsetting the RMDs that you do have to take. Qualified longevity annuity contract. I'm not a big fan of these, I'm going to be honest, because there's a lot of restrictions that come around and you have to build in some of the benefits to protect against those, like building in a death benefit that aren't automatically included. And so when you build that, you end up decreasing the income you can take out of these. And is it worth it to all these clients to only take $210,000 out of their portfolio and exclude it from the RMD calculation till 85? It might, but we've worked on a lot of these, and I'd say about 1 in 5 cases where it's been brought up, it's actually been beneficial to the client. But when it does work, it works. You can park $210,000 into a deferred income annuity, exclude it from the RMD calculation until 85 when they need to start taking income out of it. And when they start taking income out of it, it's discounted from the RMD calculation because you've lost your cash value essentially. You can't pull from that cash value. You do have a death benefit, so there is a small amount of fair market value, but it's majorly discounted, and then once again, like we talked about before, it offsets those required minimum distributions that you need to take. Roth conversions. Now, I hear this one a lot, and I'm going to go into some of my critiques of it as well. But partial Roth conversions over a 2 to 7 year period within an accumulation annuity. The issue I see is a lot of people are using bonuses to pay this. And if you are having regular meetings with your clients, they understand what they're doing. That can be a good strategy. But a lot of those bonus products have very low cap and pars. And some of their caps even have spreads on them on the basic S&P 500. They incentivize you going into volatility controls that don't yield anything, and they have fees. So your floor isn't zero anymore. It's a percent that you're taking out of your portfolio. So you can still lose money in a strategy like this, but you can front end with that bonus the Roth conversion in the first 2 years. But then they're stuck in this product for another 8 years and having very little growth. And what a lot of people are doing is they're pulling out at that point. But then the bonus needs to be recaptured. And now they're leaving that contract with surrender charges plus the bonus recapture plus MVA. That's equaling greater than 15% taken out of that cash value. That's a huge cost on the client for this Roth conversion. The strategies I like seeing more are a high cap strategy in a 7 year product and basing the Roth conversion over what you earn on a year-to-year basis and having yearly meetings so that clients are invested on a year-to-year basis and knowing what is happening along the way. It takes longer to convert, but they're less likely to pull out early and less likely to have that kind of surrender charge built upon them. And high cap products without fees do better in the long term than bonus products. So they're going to have a higher growth potential than they would in the bonus product. Longevity insurance, 1035 into a fixed index annuity. And now there's 3 ways to do this for longevity insurance. You can get a long guaranteed roll-up. Now you don't care about the cap and the pars. You're just caring about how long that guaranteed roll-up is. Because eventually at some point you might use it. A short guaranteed roll-up horizon, but you have high cap and par so that at the end of the roll-up, you can convert and still have some growth so you can keep converting into income annuities. Or indefinite non-guaranteed roll-up. So there are products out there that are going to have index roll-ups, and it's going to be a bonus on whatever you earn from the index. So if you earn 4%, you'll get 8% on your roll-up, and that will last for life because you might have some 0 years in there. And that can be really beneficial for somebody who's just saying, I'm parking it, I don't want to touch it again. Because at that point, they're going to have roll-ups for life. It's going to be on a non-guaranteed basis, but at least they know that their income value will continue to grow for this longevity insurance. And then time segmentation. We've talked about ladders before. That's essentially what this is. So you take a highly appreciated qualified funds and build income or accumulation or a mixed ladder. An income ladder will say, I want to take some income now in 5 years, 10 years. So you allow that roll up to help increase your income over time and hedge against inflation or the increase in spending for medical costs. Accumulations spreads the renewal rate risk over time so that your next renewal period might not be in a high interest rate period, might be in another close to zero period, and then you're going to be stuck rolling over into a terrible product. So you can start to build a ladder of 3, 5, and 7 year products so that you're dispersing that risk over time. And that over a long period of time will increase the yield because you're not having these ups and downs in what your guaranteed rate is or your cap and pars are. Or mixed where you're saying, I'm going to take some income and then I'm going to put some into a fixed index where it might have higher yield. And then I'm going to de-risk some in a multi-year guaranteed annuity. and that's going to be turned into income later on. All these are strategies that you can ladder and do for time segmentation. Next, in terms of easiest, underinsured. This one's going to be really simple. You guys know how to do this. 1035 into a 10-year period certain annuity and 10 pay into a life insurance policy. It's that easy. We're seeing more and more of this with people who are getting to the age where they can't buy any more annuities if they were to get out of this one. So let's say you're in your 80s. Well, there are some whole life products that you can buy that might look like final expense, but you can get higher death benefit. And the individual might say, "Look, I know I don't need this money anymore, so I can either get the guaranteed growth and then roll over to what they give me, or I can 10 pay into a whole life policy and get a higher death benefit that will be tax-free in my heirs." It's a good strategy for people who know that they don't need this money anymore. Now, long-term care coverage. We did talk about this a little bit last week, but we're going to go into again. So if you have long-term care need, apologize. Client with the long-term care need, and that you have a non-qualified annuity. It's really easy. You just directly fund a long-term care annuity or hybrid LTC policy, 1035 exchange it. It's that simple. If it's qualified, it's also simple, but we all have in our heads that long-term care won't take qualified money. When really, we can still fund long-term care using qualified annuity. It just can't be a 1035 exchange. And so the question becomes, do you want to pay the taxes out of the income or do you want to pay it out of pocket? So you 1035 into a 10-year period certain annuity, and that income buys a 10 pay hybrid LTC. Now, they do need to be able to qualify for hybrid LTC. But you can 10 pay into that, and then you just decide with the client, is the taxes on this going to come out of that income payment? So we're going to lessen the amount that's going into the hybrid LTC, or are you fine paying that tax out of pocket because you're getting this policy? Now, if they can't qualify for hybrid LTC, this is not long-term care. I want to make that clear, but it is longevity insurance with an income doubler. We're going back to that longevity insurance idea of buying an income annuity, but we're making sure that it has a long-term care doubler. And now you will only activate that income upon a long-term care event, or if your retirement funds are in danger. Of course, you're going to tap into it then. But you'll then have doubled income for 5-6 years, and then it will drop down in half back to the original amount for life. This could also be a good play, and I see a lot of people building it in with long-term care for people who have fear of Alzheimer's or cognitive diseases of aging, where their life expectancy won't be shortened, but they're going to need to be in care for a long time. The average stay in long-term care is 4 years, which means 50% people are going over. And of that 50%, we're looking at 40 to 60% that are staying longer than 8 years. No long-term care product is paying over 8 years unless you're getting a lifetime benefit, which is going to reduce the amount. So pairing a income doubler with a long-term care annuity can be a good use as well. Now, philanthropy. This one is going to be a lot of tax talk, and that is not my area of expertise. I am just conveying what advisors we work with are doing. So you are going to need to work with the tax professional to be able to pull these off. You're going to be working with attorneys to set up the trust. I'm passing the buck on that one. But you can fund a charitable remainder trust, 1035 into an income annuity, give the annuity to a charitable remainder trust, set a date for income. You receive, the client receives an immediate tax deduction. It's going to be irrevocable, and they receive income, and the remainder goes to a nonprofit at death. Fund a charitable gift annuity. So similar, but Secure 2.0 allows ability for a one-time IRA qualified charitable distribution of up to $53,000. Must be at least 70 and a half. The older you are, the better, because $53,000 does not get a lot of income. and all the income will be taxable, but you do get that front end tax benefit. Lifetime bequest, this one we're seeing more and more that with the great wealth transfer, that we're seeing people 1035 into an income annuity and allocate that income towards annual gifting to the beneficiaries underneath the annual exclusion level. They're just saying we have all this qualified funds. Those qualified funds are going to be heavily taxed at death. So how do we pull a large part out right now and create an income stream? And then that income stream we can gift out below the annual exclusion level every year to our heirs and make sure that we're seeing them put these to use instead of gifting them something that's going to be highly taxed at death. Similarly, we're looking at qualified funds donation. 1035 exchange into a 10-year period certain annuity, paying annually. Use that to fund a life insurance policy and make a charity the beneficiary of all qualified funds. So the most tax funds you're giving away at death are now going to be given to a tax-exempt entity. And you're going to replace that inheritance with tax-free life insurance proceeds. Now, ideally, death benefit should equal or exceed the qualified funds pool. And so that gives you an opportunity to increase the contribution as well. And all of these give you the opportunity to increase the contribution as well, unless you're capped by some taxes there. Now, that's the end of the 20 minutes. I know I don't have a good wrap up because we're just rapid firing sales ideas and strategies. I hope you pulled something from that. And if you have any questions about any of these strategies, do not hesitate to email or call. Now, some housekeeping before we go and some information about next week. Next week, we already decided the topic, and it's going to be a deep dive into asset-based long-term care. Now, next week, we're moving over to a webinar format. So you're going to get a new invite to sign up and register, and you'll need to re-register, even though we've always been using the same link moving up to this point. Moving forward, it's going to be a new link because it just makes it easier on our end to upload these for to present to you as a replay. So make sure you re-sign up, and if you have any questions that you want to ask here right now, I open up the floor to you. Otherwise, that was your 20 minutes. Enjoy your week, and I'll see you next Tuesday.